Sunil Mehta, Chief Executive at Indian Banking Association, is now joining us. Mr. Mehta, afternoon. Thank you so much for your time. There's a lot of stuff happening in the lenders ecosystem. First, it was more provisioning requirements specifically for project financing for some of the lenders, including PSUs and other lenders. Now there is a kind of a nudge or advisory given out by RBI to NBFCs, especially gold loan ones, to not be doing loans beyond 20,000 in cash. Before I get into specifics, I want to understand, you've been dealing with observing regulatory as well as, from both the sides for a very long time, the entire ecosystem. Are we looking at a slightly stricter version of RBI? Are things on ground really getting slightly heated that the RBI has to step in? What are you looking at as an overall observation?
Thank you for seeking my views. And in fact, RBI is definitely considered to be one of the very prudent regulator. And during even pandemic, entire world has recognized that Indian banking system was well regulated. Even they have not allowed any bank to collapse. Whenever there were some issues in any of the banks, it was taken over by some other bank with the intervention of RBI. So RBI as a prudent regulator is, I think, par excellence, and we don't have to think anything that is only about the recent guidelines which are talking about. Sometimes all these guidelines we do not know the basis on which, because RBI keeps collecting the data from the banks and NBFCs, and whenever they find that certain things which are going outside the boundary lines, they start belting the tide so that the entire financial ecosystem is properly protected and cushioned. And I think as a regulator, we find the policies of RBI as a very prudent policies, and most of them are supportive of the system.
Fair point, Mr. Mehta. In fact, there's no two ways about it. The most admired central bank in the world, not only domestically but overseas too, all agencies and observers are saying that. And the proof of pudding lies in eating, and we've seen it, how they've navigated the very tough times we have seen in our economy. But going forward, let's talk about the impact, particularly about project financing. On the one hand, everybody believes that we are forging ahead in terms of mega structures, big projects. India is undertaking projects like not done in a very long time. And we have seen that the process of underwriting projects are scrutinized very well now, much more efficiently. All the big lenders in the last so many quarters we've spoken to, it is reflected in their books and earnings. Yes, RBI may not have shared the entire basis of this particular norm right now, but as an observer from the banking side, the growth rates in project financing, the rates at which the projects are being financed, and the process, do you think it merits a closer look, or on the face of it, it doesn't look like right now, and this is just a precautionary measure?
So at the outset, as a disclaimer, I'll say, at the industry level, we are yet to give our opinion to the Reserve Bank of India. So we'll be deliberating within our committees, and we'll come out with our suggestions and recommendations. The deadline is 15th of June. So I think we have yet to discuss in our various committees. But as an individual, what I perceive from the regulations which are being put forward by the Reserve Bank of India is that they have drawn certain lessons of the previous credit cycle. The infrastructure financing, the banks were very aggressively have lent to this sector. In some of the cases, a great stress was built up in the infrastructure book. Many of the infrastructure companies which were there in the line, which have adopted the PPP model, are now no more existent. Most of them have gone to NCLTs. So some stress was built up because bankers were not having full experience about it, and they have learned the experience in a harder way. So now RBI has started tightening the belt for project financing and infrastructure. One thing what they are trying to do is bringing in more discipline for execution capabilities. Earlier, there was a time where bankers used to lend even waiting for, in the anticipation of certain sanctions or regulatory clearances, they will go ahead with their project lending. Maybe in the anticipation of financial closure, they will some of the banks will release their funds, and in the process they are stuck up. And sometimes when the financial closure will take a longer time, then of course it added to the cost of the project. So keeping all those things in mind, I think now to bring everything in the ambit, they say these are we can't have a financial closure unless all the regulatory clearances have been obtained, sanctions been made, a majority, at least minimum 50% of the land is acquired for PPP model, and so these enablers will bring a greater discipline and reduce the asset quality in the infrastructure sector. So the suggestions and the intentions of RBI is providing the greater guidelines to the entire financial ecosystem to look at what not to look and how to treat the different events, credit events during the process of project execution.
Right. No, so intent is really clear from the RBI. They do want to, of course, push the infrastructure development, but not at the cost of the quality. But Mr. Mehta, also wanted your take. What are the next steps now? We understand that the Finance Ministry has also taken cognizance of the same, and they are seeking your advisement for this as well, and then reach out to SBI, or rather RBI, beg your pardon. When is that meeting expected to happen? When would you make the recommendation? What, in your own assessment, should be the timeline of this implementation?
So actually, the timeline for submission of our suggestions to RBI is 15th June. Definitely, we have already started informally deliberating within lenders, and formal we will conduct the meetings and firm up our views what to submit to the RBI for implementation of the proposed project guidelines for implementation of the project. But one thing I'm sure, the systems being proposed have an edge over the systems which were prevalent in the past. Why I shall tell you, few of the things which were there earlier, one thing which is going to cost more to the bank is increasing the standard provisioning from 0.4 to initially 5% during the project, then to 2.5%, and then to 1%. So, but even at the end of the project implementation, it will 1%. So 1.5 times the standard asset provisioning will be there. So that will provide some cushion, because provisioning is not doesn't go out of the book. It provides a cushion to the bank to ring fence the if something goes wrong. The another impact, the 5% and 2.5% flexibility that is given. So at least now the business models of the banking will also change. Earlier, entire 20 lakh, let's say 20-year project was funded at a uniform rate of interest, or sometimes it was on the uniform terms. Now it has been segregated into two. The risk involved into the pre-implementation stage, that is till the DCCO is obtained, and the risk of the post-implementation. So what will happen? The takeout financing will now be more prominent. Takeout financing, where some of the lenders taking higher risk during implementation stage, because that is a time where the chances of things going wrong are more. So, so that will they will be taking higher risks. It may be higher priced also, because there will be higher capital cost because of the provisioning requirement, and provisioning requirement will bring the higher cost. So implementation time will be little issue. But once the project is achieved to the DCCO, then of course automatically, without referring back to the RBI, it can be reduced to 2.5% up to extended period of maybe. And that period will not be more than 1 year, because 6 months, 1 year was available earlier. Now it will come down to 6 months. And after that, automatically, when there is a sufficient cash flows to meet out, it can be reduced to 1%. So the entire tightening of belt is only project execution period.
It's only for the time period, and then it could be brought down. Thanks, Mr. Mehta, for putting that into perspective. Appreciate you joining us. But in the meantime, the answer.
If you like this video, then like, share and subscribe to ET Now.